Imagine for a moment that you owe just a staggering amount of money. I mean, millions of rupees.
Right.
And the due date is circled in red on your calendar, and it's creeping closer every single day.
Ooh, the stress of that.
Exactly. But then something totally unexpected happens. The company you owe all this money to, they just completely collapse.
Wow.
Yeah, they go bankrupt, they shut their doors, the phones are disconnected, the executives just, scatter.
A total implosion.
Right. So the due date arrives, and nothing. No one calls, no one sends an invoice, no one knocks on your door demanding payment.
Cricket.
Pure crickets. So if you're the person who owes that money, I mean, human nature kicks in, right?
Oh, absolutely.
You might just quietly erase that due date from your calendar.
Yeah.
You might think, well, the entity I owed money to essentially evaporated into thin air. Looks like I just dodged a massive financial bullet.
You'd definitely be tempted to think that.
Right. You might even try to quietly wipe that debt right off your books. But here is the really critical question for you today. In the rigorous, unforgiving world of corporate finance and accounting standards, does the silence of your creditor actually erase your debt? Or are you just hiding a ticking time bomb on your balance sheet?
I mean, it's a phenomenal premise.
Yeah.
And it gets right to the heart of, well, one of the most common instincts in corporate management.
Which is?
The desire to use a circumstantial technicality to avoid recognizing a really painful economic reality.
Oh, for sure.
When a company sees an opportunity to just make their liabilities disappear, they will almost always try to take it. But as we're going to see in this deep dive, the accounting frameworks governing these situations they're specifically designed to be incredibly unsympathetic to those kinds of hopes.
Very unsympathetic. Well, welcome to a brand new episode on the JAP Advisors Endless Clinic podcast. We're so glad you're here.
Thrilled to be doing this deep dive today.
Yeah, today we are opening up just a fascinating case file. This is sourced directly from the JAP Advisors issue repository. We're going to take a highly complex, real-world accounting puzzle, and we're just going to completely deconstruct it.
Take it right down to the studs.
Exactly. We want to understand not just what the rules say, but the fundamental logic and the mechanisms driving those rules. And I really want to speak directly to you, the listener, right now, especially if you are an everyday person investing your hard-earned money in the stock market.
Which so many people are doing right now.
Right. You might be looking at the topic of today's deep dive, things like Ind AS 32, preference shares, derecognition, and you might be thinking, this sounds like back office paperwork. Why do I need to understand this?
It's a question we hear constantly, honestly.
So what's the answer? Why should they care?
Well, the answer is that accounting standards are the literal language of business.
The language of business. I like that.
Yeah, I mean, when you buy shares in a listed company, you're relying entirely on their financial statements to tell you the truth about their financial health.
Right.
If you can't read that language, you're vulnerable. If you don't understand how a company's liabilities are classified, or, if you don't realize they might be hiding massive debts behind confusing equity-sounding terminology.
Which happens all the time.
All the time. Then your investment isn't an informed decision at all. It's essentially a blind gamble.
A roll of the dice.
Exactly.
Yeah.
Understanding the mechanics of these standards allows you to see past the labels the company wants you to see and actually recognize the economic substance beneath.
That's incredibly well put. Okay, before we lay out the specific facts of the mystery we're solving today, we just need to establish some ground rules for our analytical framework. We want to be incredibly precise here.
Always a good idea.
So first, the functional and presentation currency for the companies we are discussing today is the Indian rupee, the INR. That means any other currency that might, theoretically enter the conversation would strictly be treated as foreign currency. Second, the reporting period we're referencing strictly begins on the 1st of April and ends on the 31st of March.
Those are critical parameters. And furthermore, all of my analysis today is grounded strictly in the Ind AS framework, the Indian accounting standards.
Right. But we have a lot of international listeners, too.
We do. And for our global audience, there's a very important point to make here. For the specific topics we are dissecting today, financial liabilities, derecognition, and provisions, there is absolutely no difference between Ind AS and IFRS.
Oh, really? None at all?
None. The principles are identical. So if you are working under the IFRS framework anywhere in the world, you can apply this entire discussion directly to your own entities without any translation required.
That's fantastic. That universal application makes this case study incredibly valuable for everyone listening. Now, one final piece of housekeeping. We must explicitly state our legal disclaimer.
Yes, the lawyers insist.
They always do. The views expressed in this deep dive are the personal views of the author of the source material and are not binding on you, the audience. You are strongly advised to seek the help of a professional expert before taking any action or, refraining from any action based on the views discussed herein.
Precisely. We are your guides to understanding the material, but we are not your personal auditors or financial advisors.
Exactly. All right, disclaimer done. So, what exactly are we looking at today? Let's lay out the facts.
So do it.
Okay, we have a subsidiary company. Let's just call them Company A.
Makes sense.
Company A issued a specific financial instrument to its holding company, which we will call Company B.
Okay.
The instrument is called and I'm quoting here, redeemable preference share with a cumulative dividend.
Okay, let's just pause right there, because every single word in that title carries massive legal and economic weight.
It's a mouthful, isn't it?
It really is. A parent-subsidiary relationship is already a complex dynamic, but injecting this specific instrument adds a profound layer of obligation.
We will definitely tear into that terminology in a moment, but let me finish the timeline first.
Go ahead.
So, Company A, the subsidiary, they fall on hard times. They suffer significant financial losses.
Ouch.
Yeah. And because they're operating at a loss, they do not pay any of the dividends on those preference shares to Company B.
Okay, that tracks.
Time passes. We fast forward to the official redemption date. This is the predetermined day when Company A is contractually required to buy these shares back.
Right, the day of reckoning.
Exactly. By this date, both the core share value, meaning the principal, and a massive, towering pile of unpaid cumulative dividends are outstanding.
That is a very heavy financial burden that has suddenly come due all at once.
It is. But here's the twist. Company B, the holding company that is owed all this money, they've gone into liquidation. They are financially ruined and are being wound up. Because of the absolute chaos of their liquidation process, when that redemption date arrives, Company B doesn't make any formal claim for the money. They don't send a letter. They don't demand the cash. They are completely silent.
So Company A is sitting there staring at this massive liability, knowing the due date has arrived, but the person they owe it to has essentially vanished into the legal machinery of insolvency.
That's exactly it. And that silence prompts Company A to ask 3 very urgent questions, which form the core of our source material today.
Love to hear them.
Query number 1. Where do these preference shares actually go on the financial statement? Are they a liability, are they equity, or some combination of both?
Okay.
Query number 2. Since they didn't pay the cumulative dividend, Company A currently has it listed off the balance sheet as a contingent liability. Is that correct?
Interesting.
Right. And query number 3, because the holding company is liquidating and no claim was made, can the unredeemed shares themselves also be shown as a contingent liability?
I see where they're going with this.
Essentially, they're asking if they can use the holding company's liquidation as an excuse to just sweep this entire financial mess right into the footnotes.
It is a textbook attempt at regulatory arbitrage.
Really? You think they're doing it on purpose?
Oh, absolutely. They are trying to leverage the ambiguity of a quote-unquote share label combined with the real-world chaos of a liquidating creditor to vastly improve how their balance sheet looked to the outside world.
Wow. Okay, so how do we unravel this?
To unravel this, we have to start at the very foundation. We have to strip away the title of the document and look at its soul.
Okay, let's unpack this. Section 1. The identity crisis. When a, quote, share is actually a debt.
Let's get into it.
We are dealing with an instrument called a preference share. Now, if I am a retail investor or even a junior accountant and I see the word share, my brain immediately categorizes that as equity.
Naturally.
Right. You buy a share, you own a piece of the company, you share in the risks, you share in the upside. If the company does well, you get dividends. If it does poorly, you get nothing. It's ownership, not debt.
That's the common understanding, yes.
But the query itself hints that Company A is unsure. It feels a bit like a landlord calling a mandatory monthly rent payment an optional community donation. Like, the label doesn't match the reality. Why is the accounting standard suspicious of the word share?
The standard is suspicious because history has taught standard setters to be incredibly suspicious.
How so?
Well, for decades, corporate lawyers and investment bankers have been incredibly creative. They design financial instruments that legally look like equity, but economically function exactly like debt.
But why? What's the benefit of doing that?
Lots of reasons. Sometimes it's for tax advantages. Sometimes it's to avoid violating debt covenants with other lenders. And honestly, sometimes it's simply to make a highly leveraged company look much healthier than it actually is.
Ah, to trick the investors.
Essentially, yes. Because of this historical game of dress-up, the Ind AS framework relies on a fundamental, unshakable philosophy: substance over form.
Substance over form, meaning what the thing actually does is infinitely more important than what the lawyers named it.
Yes, exactly. And AS 32, which governs the presentation of financial instruments, couldn't care less if you stamped the word equity share in gold foil on the front of the contract.
Right. It ignores the gold foil.
It ignores the form completely and interrogates the substance. And that interrogation starts with paragraph 11 of Ind AS 32, which defines what a financial liability actually is.
Okay, and what is the core test in paragraph 11? How does it cut through the naming convention?
It establishes several criteria, but the absolute bedrock trigger, the ultimate litmus test, is whether there is a contractual obligation to deliver cash or another financial asset to another entity.
Obligation to deliver cash.
Yes. If the issuing company has an unavoidable obligation to hand over cash, it is a liability, period.
Let me push back on that, though, just for a second. Let's look at corporate law. Under the Companies Act, or really any standard corporate legal framework, a dividend is not legally owed until the board of directors formally declares it.
That is correct.
Right. And a board usually cannot declare a dividend unless there are sufficient distributable profits. Now, the facts of our case state that Company A suffered losses. They didn't have profits.
Right.
So the board didn't declare a dividend. So legally speaking, there is no obligation to pay those dividends. How can an accounting standard override the legal reality of a board declaration and call it a liability?
That is a brilliant point, and it perfectly highlights the tension between legal form and accounting substance. You are entirely correct about standard equity shares.
Okay.
If Company A had issued normal, non-cumulative equity shares, the lack of a board declaration due to losses would mean the dividend vanishes.
It just goes away.
Right. No legal obligation is created, and therefore, under Ind AS 32, no financial liability exists. But you have to look closely at the specific adjectives attached to the instrument in our case study.
The adjectives.
Yes. It is a redeemable preference share with a cumulative dividend. Those two words completely change the economic DNA of the contract.
Let's break those down, starting with redeemable. What does that do?
Redeemable means that on a specific, predetermined date in the future, Company A is contractually forced to buy those shares back from Company B.
They have no choice.
None. They do not have the option to say, we'd rather hold on to our cash. They are legally bound to hand over cash to redeem the principal amount. Therefore, regarding the principal, the unavoidable obligation to deliver cash exists from day one. That portion is undeniably a liability.
Okay, I follow that for the principal. The redemption date creates a hard wall they have to crash into. But what about the dividends? Again, no profits, no declaration.
That is where the word cumulative comes in.
Okay.
With a cumulative preference share, the missed dividend does not vanish. If the board doesn't declare it in year one because of losses, that dividend obligation is essentially, well, it's put into a holding pen.
A holding pen.
Yeah, it accrues. It accumulates. Year two comes along, they make a loss again. Year two's dividend goes into the pen. Now you owe year one and year two.
Yeah.
And here is the mechanism that triggers Ind AS 32. Company A cannot redeem the principal, nor can they ever pay a single rupee of dividend to their normal equity shareholders until every single accumulated arrear in that holding pen is paid out in full, in cash.
So the obligation hasn't been canceled by the lack of profits. It's merely been delayed.
Exactly.
The standard recognizes that to fulfill the ultimate contract, which is the redemption, they will eventually be forced to pay all of it.
Precisely. Because the redemption is mandatory, the payment of the accumulated dividends also becomes practically mandatory. The company has no unconditional right to avoid delivering cash to settle those accumulated dividends.
Wow.
Therefore, paragraph 11 slams the gavel down. The entire instrument, the principal, and the promised cumulative dividends, it functions as a debt. The economic substance is pure debt.
So to answer the very first part of Company A's query, where does this go on the financial statement? The answer is uncompromising. It goes under liabilities. It is not equity.
It is 100% financial liability. The name share is totally irrelevant. But understanding that it's a liability is really only half the battle. The fascinating part is how we actually measure and present that liability mathematically over time.
Especially regarding those unpaid dividends.
Yes.
Yeah.
And AS 109 dictates that this type of financial liability must be measured at what is called amortized cost.
Amortized cost. Okay, now we are getting into the heavy machinery of the standard. I know a lot of people hear amortized cost and their eyes just sort of glaze over.
Oh, totally.
But the mechanics of this are crucial to understanding why Company A is in so much trouble. Can you walk me through the mechanism of amortized cost in this specific context?
Sure. To understand amortized cost, you have to understand its engine, which is the effective interest rate method.
Okay.
Let's compare it to something more familiar. Let's say you take out a complex loan from a bank. You borrow 100 million rupees.
Right.
The bank says, hey, we won't charge you interest in cash every year, but at the end of 5 years, you have to pay us back the 100 million principal, plus a massive balloon payment of 50 million to cover all the accrued interest.
Okay, a zero coupon structure, basically. No cash leaves my pocket until year 5.
Right. Now, if you only looked at cash movement, you might think you have zero interest expense in years 1 through 4.
Which would look great on my income statement.
It would look amazing. But accounting standards don't allow that because it distorts reality. You are utilizing the bank's money every single day, so you are incurring a cost every single day.
Makes sense.
The effective interest rate method mathematically maps out all expected future cash flows so that final 150 million payment and smooths that cost out over the 5-year life of the loan. It calculates the true internal rate of return the bank is getting.
So even though no cash is actually moving, your balance sheet liability grows every year, and your profit and loss statement takes a hit for interest expense every year.
Exactly. Now, map that exact same logic onto our redeemable cumulative preference shares. The principal repayment is the redemption amount. The quote-unquote interest payments are those cumulative dividends. The standard dictates that we don't care that they're called dividends, which sounds like an equity distribution. Because the instrument is classified as a liability, the cost of servicing that instrument is classified as an interest expense.
Wait, really? So on the profit and loss statement, it literally shows up as a finance cost or interest expense. It doesn't show up in the statement of changes in equity where normal dividends go.
Absolutely not. It is presented as a finance cost in the P&L. Let's walk through a hypothetical timeline for Company A.
Okay, let's hear it.
Let's say the preference shares were issued for 100 million rupees with a 10% cumulative dividend, redeemable in 5 years. In year 1, Company A suffers losses. They pay zero cash to Company B.
Right.
But behind the scenes, the accounting standard forces them to do a calculation. They have to recognize that 10 million rupees, the 10% dividend, as an interest expense for year 1.
So their P&L takes a 10 million rupee hit, making their losses look even worse.
Yes. And what happens to the balance sheet? Because they didn't pay that 10 million in cash, the liability on the balance sheet grows. It started at 100 million. At the end of year 1, the liability is now 110 million rupees.
Wow. Okay, I see. And year 2?
Year 2, if they use compound interest, the finance cost is calculated on the new carrying amount of 110 million. So the interest expense is now 11 million.
It's snowballing.
Exactly. The total liability grows to 121 million. This compounding effect happens every single year. The liability swells mathematically, driven by the effective interest rate, regardless of whether a single rupee of cash actually changes hands.
You know, that mathematical reality completely destroys Company A's argument in their second query.
How so?
Well, they asked if it was correct to list the unpaid cumulative dividend off to the side as a contingent liability. They were basically treating it like a what-if scenario. Like, what if we have profits eventually, then maybe we will owe this.
Yeah, that is a profound misunderstanding of the standard. A contingent liability is something that might happen. But because of the effective interest rate method, the accrual of this dividend is an absolute certainty.
And it's baked in.
It is a mathematically calculated, recognized component of the carrying amount of the debt. It is hardwired into the amortized cost. You cannot extract the dividend component, call it a contingency, and hide it in the footnotes while keeping the principal on the balance sheet. They are one unified, growing organism of debt.
The standard is incredibly robust here. It's like standard setters anticipated every possible naming trick and built a mathematical net to catch it all. The substance is debt, the cost is interest, and the presentation must reflect a growing compounded liability.
Exactly. So we have established the grim reality for Company A. They have a massive liability that has been ballooning year over year. The redemption date has arrived, they owe the principal, and they owe years of accumulated dividend arrears.
Right. But now we have to introduce the chaos factor.
Yes.
Section 2 of this saga, the ghosting creditor and derecognition.
This is where it gets really interesting, because the facts state that Company B, the holding company they owe all this money to, has gone into liquidation.
Let me look at this from a purely pragmatic business perspective. Let's put ourselves in the shoes of Company A's CFO.
Okay, let's play CFO.
You are staring at a massive liability that is threatening the survival of your own company. The due date arrives, but the entity you owe the money to is basically a burning building.
Right.
They're in the chaotic throes of insolvency. The executives are gone. They haven't sent a demand letter. They haven't made a claim on the redemption date. If I'm that CFO, I am going to my auditors and saying, look at reality. Company B is dead.
Yeah.
There is no functional entity asking for this cash. Why on earth should I keep a ghost on my balance sheet? Let's de-recognize it. Let's write it off.
It is a seductive argument, I'll give you that, because it appeals to common sense. If nobody's asking for the money, why act like you still have to pay it? But Ind AS 109, which governs the derecognition of financial liabilities, it does not operate on casual common sense. It operates on rigid legal and economic thresholds. And this is found in paragraph 3.3.1 of Ind AS 109.
The extinguishment rules.
Yes. What's fascinating here is how rigid the concept of extinguishment is. Paragraph 3.3.1 dictates exactly when a company is allowed to remove a financial liability from its balance sheet. It states that an entity shall remove a financial liability when, and only when, it is extinguished.
Extinguished is a very final word. How does the standard define it? Because my definition as CFO might be the guy I owe money to lost his phone and forgot about it.
The standard is mercilessly specific. It gives us 3 and only 3 doors out of the room. A liability is extinguished only when the obligation specified in the contract is 1, discharged, 2, canceled, or 3, expires.
Okay.
If you cannot walk through one of those 3 doors, the liability stays on the balance sheet.
Okay, let's test Company A's situation against the 3 doors. Let's take them out of order. Door number 3, expired. Has the contractual obligation expired? The redemption date came and went? Does a debt expire just because it's past due?
Absolutely not.
Right.
Missing a due date does not make the contract expire. It puts you in default.
Right.
It actually makes the liability more urgent, not less. The contractual obligation to pay remains fully in force. So door number 3 is locked.
Door number 1, discharged. To discharge a debt usually means you performed your end of the bargain.
Which almost always means you paid cash or transferred another asset to settle it. Have the preference shares and the accumulated dividends been paid out?
No, the facts state clearly that both are outstanding. Not a single rupee has been paid. So door number 1 is locked.
Which leaves door number 2, canceled. This is the entire foundation of Company A's hope. They are arguing that because Company B is in liquidation and failed to make a claim on the due date, the debt is effectively canceled by default.
It's the statute of limitations argument, essentially. Like,
Yeah.
you didn't ask in time, so we're canceling it. Does the standard accept that?
The standard rejects it completely. And to understand why, we need to bring in an analogy. Think of a liquidator, not as an executioner, but as a probate lawyer managing the estate of someone who just passed away.
Okay, I like that. So the company is the deceased, the liquidator is the executor of the estate.
Right. When a person dies, their assets don't just become free for the taking. The executor's job is to scour through every file, every bank statement to find every single asset that belonged to the deceased.
True.
Their fiduciary duty is to gather all that wealth so it can be distributed to the deceased person's heirs or creditors. When Company B goes into liquidation, an official liquidator is appointed. What is their primary mandate? To maximize the value of Company B's estate to pay off Company B's creditors.
And from the liquidator's perspective, Company A's massive unpaid debt, the 100 million principal plus years of compounded dividends, it isn't a forgotten technicality. It is an incredibly valuable asset belonging to the estate they manage.
Exactly. It is a massive receivable. Just because the liquidator is busy sorting through the wreckage of Company B and hasn't had the time to knock on Company A's door yet, does not mean the asset ceases to exist.
Oh, man.
The liquidator has a legal obligation to eventually identify that preference share agreement and demand the money. The event of the holding company going into liquidation does not magically erase the subsidiary's debt. The silence of the creditor does not equate to the legal cancellation of the debt.
So the passive failure to demand payment is fundamentally different from actively canceling the debt.
Completely different. For a debt to be considered canceled under Ind AS 109, there must be an explicit legally binding action.
So under what specific rigorous circumstance could Company A actually unlock that second door? What does a legal cancellation look like in the context of insolvency?
The only way that liability comes off Company A's balance sheet without cash changing hands is if the appointed liquidator, The person legally in control of Company B's assets determines that pursuing the debt is impossible or not worth the legal fees. Perhaps Company A is also nearly bankrupt. In that scenario, the liquidator must draft a formal legal document explicitly waiving the right to claim that specific amount. They must formally forgive the debt in writing.
A proactive, legally defensible waiver.
Yes. Only when that explicit legal waiver is signed and executed does the obligation meet the definition of canceled under paragraph 3.3.1. Until that precise moment occurs, passive silence means absolutely nothing.
Wow.
The liability must sit firmly on the subsidiary's balance sheet, continuing to accumulate interest, accurately reflecting the fact that they are legally exposed to a massive future cash outflow. You cannot derecognize the liability under Ind AS 109 based on a presumption of safety.
That clarifies the mechanism perfectly. And frankly, if you think about the macroeconomic implications, standard setters had to write it this way.
Definitely.
Because if companies could just arbitrarily write off debts because they felt their creditor was distracted or, unlikely to collect, the potential for massive financial fraud would be astronomical. It would turn balance sheets into works of fiction.
The standards are designed to reflect the brutal, objective reality of contractual obligations, completely insulated from the subjective hopes of management.
Okay, so let's summarize the damage for Company A so far. They tried the identity trick. They pointed to the word share and said it was equity. And AS32 interrogated the substance, found a mandatory cash outflow, and defined it as a financial liability measured at amortized cost.
Check it.
Then they tried the ghosting creditor loophole. They pointed to the liquidation and asked to derecognize it. And AS109 demanded a formal legal waiver, which doesn't exist, keeping the liability chained to the balance sheet.
They are systematically running out of options to make their financial position look better.
Which leads us to Section 3, the contingent liability trap, their final, desperate attempt to manage the optics.
Let's see what they try next.
So what does this all mean for the balance sheet presentation? Their third query asks, because the holding company is liquidating and no claim was made, can the unredeemed shares not redeemed also be shown as a contingent liability? They basically want to take the whole mess, the principal and the cumulative dividends, and just shove it into the footnotes.
It is the classic fallback position. When a company cannot legally delete a massive liability, their next move is to try and demote it.
Demote it?
Yeah, they want to move it from the face of the balance sheet, where it destroys their debt-to-equity ratios, into the disclosure notes at the back of the annual report, where hopefully fewer people will notice it. And they are attempting to use Ind AS 37 to do this.
Well, let's explore Ind AS 37 then. It deals with provisions, contingent liabilities, and contingent assets. First, let's establish what a contingent liability actually is in the spirit of the standard, so we can see why Company A thinks they have a case.
A contingent liability, by definition, is a possible obligation. It arises from past events, but its actual existence will only be confirmed by the occurrence or non-occurrence of one or more uncertain future events that are not wholly within the control of the entity.
Okay, the classic example is a pending lawsuit. Yeah.
Exactly.
Yeah.
Your company gets sued for patent infringement. That's a past event. But you don't know if you actually owe any money until the judge issues a ruling next year.
Right.
That judge's ruling is the uncertain future event. You have a possible obligation, so you disclose it in the footnotes, as a contingent liability to warn investors, but you don't book a hard liability on the balance sheet yet because the outcome is genuinely uncertain.
Okay, let me play devil's advocate for Company A again. I can see why they think their situation fits that definition perfectly.
How so?
The past event is the issuance of the preference shares. The uncertain future event is whether or not the liquidator eventually finds the paperwork and decides to sue them for the money. If we know we owe it, but we're just waiting around to see if the liquidator actually knocks on our door, isn't that the very definition of a contingency? Can't we just stick this in the footnotes?
It's a clever argument, but it conflates the certainty of the obligation with the certainty of the enforcement.
Oh, that's an interesting distinction.
In a lawsuit, the existence of the obligation itself is debated. You are arguing you didn't steal the patent. But in Company A's case, there is no debate about the obligation. They signed a contract agreeing to pay 100 million rupees plus dividends on a specific date.
Right.
The obligation is absolute and certain. The only uncertainty is whether the creditor will enforce their rights. Accounting standards do not allow you to classify a known debt as a contingency just because you hope the repo man gets lost on the way to your house.
That is a crucial philosophical distinction. Uncertainty of enforcement does not equal uncertainty of obligation.
Exactly. But beyond the philosophical debate, there is a much more blunt, mechanical reason why Company A's strategy fails here. And it is found right at the beginning of the rulebook in paragraph 2 of Ind AS 37.
What does paragraph 2 say? Because if we connect this to the bigger picture.
Paragraph 2 establishes the jurisdictional boundaries of the standard. It contains a massive scope exclusion. It states explicitly, this standard does not apply to financial instruments that are within the scope of Ind AS 109.
Oh, wow. It's a jurisdictional turf war, and Ind AS 109 already planted its flag.
That's a perfect way to put it. The standards operate in a strict hierarchy to prevent companies from shopping around for the most favorable accounting treatment. If you have a financial instrument, Ind AS 109 is the supreme authority. And AS 37 is essentially a residual standard for liabilities. It handles the messy, uncertain stuff that doesn't fit neatly into the highly mathematical world of financial instruments.
Let me make sure I am tracing the logic chain perfectly here. In our first phase of analysis, we used Ind AS 32 to prove that the redeemable cumulative preference share is definitively a financial liability.
Yes.
Because it is a financial liability, it is governed by the measurement and derecognition rules of Ind AS 109.
All right.
And because it is governed by Ind AS 109.
It triggers the scope exclusion in paragraph 2 of Ind AS 37. The moment an item falls into the gravity well of Ind AS 29, it is categorically banned from being evaluated under Ind AS 37.
So company cannot even open the Ind AS 37 rulebook. They are forbidden from applying the contingent liability definition to this instrument.
Exactly. Why did standard setters create this scope exclusion? To prevent exactly the kind of regulatory arbitrage Company A is attempting. If you allowed companies to take hard financial instruments and subjectively reclassify them as contingencies based on external circumstances like a liquidating creditor, you would destroy the comparability and reliability of financial statements globally.
It would be chaos.
Total chaos. The scope exclusion is a firewall designed to keep the objective reality of debt separate from subjective estimates of provisions.
It's brilliant in its structural simplicity. It just shuts down the loophole before the debate even begins. So to finally and definitively answer the third query from the source material, can the unredeemed shares be shown as a contingent liability?
Absolutely not. Neither the dividend cash flow nor the redemption cash flow can be hidden away in the disclosures as a contingency.
Wow.
It is a present, absolute, recognized liability.
They remain a present, absolute, fully recognized liability on the face of the balance sheet. They must be valued at amortized cost, compounding year over year, relentlessly dragging down the company's financial metrics until they are either paid in cash or until the liquidator signs a formal, legally binding waiver canceling the debt.
The diagnosis is complete, and it is inescapable.
This has been an incredibly rigorous journey through the architecture of the accounting standards. We started with an instrument that was camouflaged as equity. We watched the Ind AS framework systematically strip away the share naming convention to reveal mandatory debt.
Yep.
Then we watched it dismantle the circumstantial excuse of a disappearing creditor by demanding a legal waiver. And finally, we watched it block the escape hatch of footnote disclosure through a hard-coded scope exclusion. It really highlights how these standards act as an interlocking defense mechanism against financial obfuscation.
They are a highly sophisticated system designed to protect the integrity of the capital markets. When an investor reads a balance sheet prepared under these standards, they need to trust that a liability represents a true economic burden, not just a label management chose to apply.
It empowers the investor to truly understand the language of business. Now, as we wrap up this deep dive, I want to leave you, our listener, with one final provocative thought, something to mull over that builds on the mechanics we've discussed today. We firmly established that Company A must keep this massive debt, the principal and the years of compounded interest, on their balance sheet until the liquidator explicitly waives it.
Right. They're stuck in a holding pattern, accumulating interest, waiting for the legal cancellation.
But let's extrapolate. Let's imagine the scenario where that cancellation actually happens.
Sure.
Say it's 3 years from now. Company A's liability has compounded to just an enormous figure. The liquidator for Company B finally gets around to reviewing the file. They look at Company A. They realize Company A is also fundamentally insolvent and has zero cash. And they determine that spending millions on lawyers to sue Company A is just a waste of the estate's remaining funds.
A very realistic scenario.
So the liquidator officially signs the waiver. They formally forgive the debt.
The obligation is officially canceled under paragraph 3.3.1 of Ind AS 109. The door is finally unlocked.
Right. So my question for you to ponder is the fallout of that moment. When that legal waiver is signed, Company A is suddenly allowed to de-recognize that liability. Millions upon millions of rupees of debt are legally erased from the balance sheet in an instant.
Oof, gone.
But remember, accounting is a double entry system. You cannot just delete a massive liability. The other side of the equation has to balance. When a massive liability drops to zero without a single rupee of cash leaving the company, how does that sudden extinguishment impact the company's profit and loss statement in that specific reporting period?
Oh, it's a fascinating conceptual puzzle.
Because mathematically, extinguishing a liability creates income. Does Company A suddenly record a massive multi-million rupee gain on their income statement? Does a fundamentally failing cash-poor company suddenly report a record-breaking profit for the year simply because they were forgiven a debt they couldn't pay anyway?
And more importantly, how does an investor interpret that profit? If you aren't paying close attention to the footnotes, you might see a massive spike in net income and think the company had a turnaround year, when in reality, it's just the accounting echo of a forgiven debt.
Exactly. It shows that even when a company escapes a liability, the standards force the economic reality of that escape to echo through the financial statements in surprising ways. It is definitely something worth exploring further on your own.
Truly something to think about.
Well, we have reached the end of our analysis for today. I want to sincerely thank you for your time and your deep curiosity. Untangling the technical mechanisms of Ind AS and IFRS is intense work. But as we've seen, it is the only way to truly understand what is happening beneath the surface of corporate finance.
It gives you the analytical tools to separate reality from fiction.
Now, it is incredibly important to reiterate that the invaluable, highly complex issue we deconstructed today did not just fall out of the sky. It was sourced directly from the incredible issue repository hosted at Gap Advisors.
The depth of the intellectual capital they have built there is truly staggering.
It is an absolute goldmine. The website is https://gapadvisors.com. They host an archive of over 4,500 real-world issues, along with highly detailed, technically rigorous responses covering both Ind AS and Indian GAAP.
Wow.
And here's the best part. Any person can register on the site for completely free. Once registered, you can submit your own complex, highly specific accounting issues and receive a detailed, technically sound response delivered directly to the inbox of the email you registered with.
I really want to emphasize how critical this resource is, particularly if you are an auditor. When you are auditing a complex entity and you encounter a highly subjective application of a standard, like a client arguing for derecognition based on a liquidating creditor, you cannot just rely on a verbal debate.
You need proof.
You need concrete, defensible documentation in your audit file, proving how you arrived at the correct Ind AS application. Submitting the issue to the Gap Advisors repository and receiving a structured, expert response gives you exactly that rigorous paper trail.
It fundamentally changes how professionals handle ambiguity in the field. I also want to highlight that today's specific case study was featured in the 195th edition of the Gap Advisors Task Weekly newsletter. This newsletter is authored by C.A. Manish C. Iyer, the director of Gap Advisors, and it is published directly on LinkedIn.
It is arguably one of the most effective ways to maintain your technical edge week over week.
They have published over 230 editions to date. If you are registered on LinkedIn, I highly encourage you to search for the Gap Advisors Task Weekly newsletter and subscribe for free. It delivers high-level insights straight to your feed.
Furthermore, for those listening who might be dealing with an incredibly thorny, nuanced issue at their own entity, something that requires a dynamic conversation rather than just an email exchange.
Yes, there is a direct line available. You can actually book a one-on-one consultation to discuss your specific issues on Ind AS and IFRS directly with the author, C.A. Manish C. Iyer. You can book that consultation time with him via his page on topmate.io. Having access to that level of customized expert analysis can save endless hours of internal debate and ensure your financial reporting is bulletproof.
It provides clarity when the standards seem overwhelming.
Before we sign off, I have a few quick requests for you, our listener. If you enjoyed our deep dive into the mechanics of accounting today, please take a second to follow or subscribe to the Gap Advisors Ind AS Clinic podcasts on your platform of choice. We are fully available on Spotify, Amazon Music, and YouTube. Whichever platform you prefer to listen to the Gap Advisors Ind AS Clinic podcasts on, hit that subscribe button so you are notified the moment our next case study drops.
We have many more complex puzzles queued up for analysis.
We also highly recommend that you follow the Gap Advisors Ind AS Clinic channel on WhatsApp. It is the absolute most efficient way to get real-time updates pushed straight to your phone. You'll get alerts on all new videos, podcasts, newsletters, newly responded issues from the repository, and immediate notifications whenever new accounting standards or amendments are issued.
It acts as an incredible real-time radar for the accounting profession.
And finally, a passionate request from us to you. Please share this deep dive. Send the link to your contacts, to your professional colleagues, and to your audit and finance teams. But especially, and most importantly, please share this with students who are currently pursuing their CA course.
So important for the next generation.
It really is. The conceptual breakdowns we discussed today, the difference between legal form and economic substance, the exact boundaries of derecognition, these are the real-world applications that can transform a student's understanding and shape a successful career. Let's work together to spread critical knowledge on the rigorous application of Indian accounting standards.
Knowledge in this field is only truly powerful when it is widely shared and deeply understood.
Incredibly well said. Thank you once again for diving deep into the complexities with us today. Keep questioning the labels, keep looking for the true economic substance, and we will catch you on the next deep dive.